Many traders look to use leverage to try and amplify their profits. And although a vast majority inevitably end up losing most of their capital, leverage can actually be a useful tool when used correctly. Today we're going to be looking at how to correctly use leverage, and where better to start than the Bitcoin open interest chart, which is showing there's the current open interest of derivative contracts on major Bitcoin exchanges. We can see that this is billions and billions of dollars of capital are locked up in perpetual futures contracts and other derivatives that are made to mimic Bitcoin's price. And a big appeal of these derivative contracts is because they allow the use of leverage. Now, leverage allows you to essentially borrow capital to attempt to amplify your profits, but like we said, typically end up amplifying your losses. However, leverage isn't evil. It doesn't have to be banished. There are actually multiple circumstances in which leverage can be a useful thing. So how do we go about doing that? Well, first of all, we'll learn how to definitely not use leverage. And that is typically what we see most people do. Once we see Bitcoin open interest begin rapidly increasing, lots of people are placing their bets on the market, trying to amplify their profits, predicting the next Bitcoin move. And we can typically see after that we have a huge period of volatility and open interest rapidly decreases. This is almost always people losing a lot of their money. So to begin with, if you're seeing a huge amount of open interest increasing, especially alongside some funding rates, huge spikes to the upside or downside, this isn't really a time you want to be placing your bets on which way you think the markets are going to move. For a start, a vast majority of people can't successfully trade for a long period of time. It's considerably easier to look at a few key on-chain macro metrics and make some long-term investing decisions. But I know if you're watching this, you've probably dabbled a little bit in some more frequent trading. I know I certainly have, so it's best to learn how to not do it so we can at least attempt to do it a bit better. But we can see every hour, as this chart is representing, people holding these derivative contracts actually have to pay just to keep their contracts open. So we can see here, as I film this funding rate is currently at about 0.01%. So you might be thinking, well, that's not a lot. 0.01% of my position is a minuscule amount to allow me to borrow 10 times my capital and massively increase my profits. But if you're holding long-term positions on leverage, if we just take that 0.01%, over the course of a day, that's 0.24%. Again, it doesn't seem like a huge amount. But if you were to hold that position for a year, the funding rates were to stay the same, that's 87.6% paid in funding. It's a crazy amount of your position just lost for the privilege of being able to borrow money. So what we don't want to do is use leverage to try and amplify our profits, because we can see the volatility usually wipes out a vast majority of people. Trading is very difficult. We can see that once the funding rates are high, we also don't want to be trading with a vast majority of the crowd, because we can see, especially if we go into something like the daily chart and especially coin denominated, typically whatever the funding rates are suggesting, a majority of traders are in, because if these are negative, it means that most traders are in short positions. If it's incredibly positive, it means a vast majority of traders are in long positions. We can see traders are wrong almost all the time. We can see acting as a contrarian to what the funding rates, to what a vast majority of traders are doing, typically is your best course of action, because a majority, like we said, lose most of their money most of the time. And many, like we said, are implementing leverage to try and increase their profitability because they need to amplify the percentage gains and losses. But really, if you're in crypto and you don't think there's enough volatility, just look at comparisons to traditional markets where the S&P 500 is seeing 5, 6, 7 times less volatility. Currencies are seeing 10 times, even more, 10 times less, even less. Regardless, it's seeing considerably less volatility. If we look at BTC growth since the cycle lows, we can see that in each cycle we've seen in the first one here, 50,000% profit, 52,000% profit, 10,000% profit, and in the most recent cycle, 2,000% profit. And on a time basis as well, we can see that even though we're at over 100% returns currently, we're not even 400 days off the lows. If we were to follow any of these, we've got 1, 2, maybe even more years left of upside price action. You definitely don't want to be leveraging, losing your money before the bull cycle has really even kicked off. And the maths of leverage also really don't work in your favor. If we just go to this chart I've got loaded up here, this is QQQ, which is the NASDAQ. And what we can see here is I've actually loaded up this orange line, which is TQQQ. This is a 3 times leverage long derivative of the NASDAQ. And we can see this orange line here. Obviously, during the upside moves, this is outperforming. During the downside moves, this is underperforming. It's a leverage position. But since 2020, the NASDAQ, which has returned 80%, pretty good returns in the past few years, we can see that over that same period of time, the leveraged version of this has returned 60%. It's massively underperformed. And that's because leverage works against you. Downside moves amplify the losses considerably. If we just look at the downside drawdown here, if prices move down 35%, and then the percentage gains required to actually come back up to that level isn't 35%. If we were to draw this back up to the previous all-time high in this, you'd need a 53% return just to break even. So already the maths are against you. And I know you're then thinking, well, yeah, the NASDAQ has had a positive few years, but if I'd have gone into a short position, a short leverage position, surely that would have made up for the losses of the underperformance of my leverage long position. Well, there is SQQQ, which has actually returned minus 97% over that period of time. So no, neither of these leverage products outperformed just buying and holding. And again, this isn't even taking into consideration the holding costs, the additional fees of actually going in and out of these positions. It's very difficult to not only time these investments, but immediately the maths are against you once you do. So in what circumstance should you ever use leverage? Well, the number one benefit of leverage is it allows you to potentially more frequently trade without having all of your capital at risk. We're all aware of what happened with FTX and a number of other different exchanges and centralized services in the previous cycle. Leverage, if you're using 5 times leverage, for example, which I really do not recommend using any high leverage, but let's just say, for the sake of argument, if you're using 5 times leverage, you would only actually need to put 20% of your capital onto the exchange to utilize the leverage product. You could then leverage up, mimic the amount of capital you actually have, and then with some good risk management, you could actually then trade mimicking your entire portfolio, which is a very useful tool to have, especially if you're able to act as a contrarian and not experience these high funding rate periods. If you were to, for example, have all of your holdings in a cold wallet, a secure, personally held self-custody wallet, and move a very small fraction of your capital to an exchange to utilize some leverage products, and you were to do so when we see these huge downwards negative spikes, when a huge vast majority of the market are shorting, then not only do you not have to pay this funding, but you actually receive funding. So if you move a very small portion of your capital, just in case of any third-party, counterparty risk, any exchanges going down, you move it over, you can then have the same exposure to the market by leveraging up. You actually get paid because you're acting as a contrarian to the market. And in these circumstances, trading more frequently with appropriate risk management, leverage, like we said, can be a great tool to, yes, potentially increase your profit potential, but to reduce counterparty risk, act as a contrarian. And in certain circumstances like these, actually, if Bitcoin's price isn't doing anything, you would receive payment for just opening and holding your position, which definitely isn't a bad incentive. Especially, again, if you were to use some confluence from some more short-term metrics, if you could to look at the Crosby ratio, for example, and just take very small risk-appropriate positions. Once we see some confluence through the funding rates, once we see some massively oversold conditions, taking a small leverage position at these periods of time isn't a bad idea. If you're not holding for a long period of time, if you're not putting too much of your capital onto the exchange, if you're not over-leveraging, ultimately, leverage can be a useful tool used at your own peril. The maths are against you, and ultimately, given Bitcoin's potential and where we currently sit in the cycle, to me, it really doesn't make sense to even risk losing any of your BTC at a period where you really should be accumulating ahead of considerably higher prices. Also, if you haven't already, please don't forget to like this video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. And make sure to check out all the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your number one source for Bitcoin information. So just to summarize, leverage is a tool, not a weapon. Many see leverage as an opportunity to vastly increase trading profits, but typically end up losing a vast amount. We can see from many charts, many studies, trading is very difficult. And we can see from on-chain macro charts and technical tools that taking long-term accumulation positions and slowly averaging out of your position at the top is not only considerably easier, simpler, but considerably more profitable for a vast majority. And like we could see, leverage does actually have its benefits. It does actually have a use, as it can provide greater self-custody that minimizes counterparty risk. Like we said with FTX, I'm sure there's inevitably going to be other exchange collapses in the future, which obviously isn't a good thing, but you need to manage that risk, because just as trading risks exist for losing profit potential, counterparty, third-party risk of losing all of your capital unfortunately exists in the space. So if it allows greater positional flexibility, if you're really insisting on trading, but you only have to keep a small portion of your capital on the exchange, that's not a bad thing. Although, like we said, volatility within crypto is ripe for great, massive percentage profit gains. Leverage really is not needed. And considering how stacked against you just the maths of leverage really are, and how low the probability of long-term success really is, you can't afford to miss up the opportunity that we're currently in, given it where we currently are in the Bitcoin cycle. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know what your thoughts are on using leverage to potentially try and increase your profits or manage your risk better, greater positional flexibility, whatever it is. Let me know what your thoughts are down in the comments and on social media. I look forward to reading and replying to all of them. Thank you all very much for watching, and I'll see you in the next one.